So I'm just going to kick us off. I'm going to give us a brief overview of commercial property investing, hopefully give you some thoughts and ideas about whether this is an area that you'd like to invest in or not. To begin with, I'm just going to think about, kind of why you might buy commercial property. I'm going to have a look at the types of commercial property, consider the economic headwinds that many of you will probably be aware of at the moment, look at ways to invest in commercial property, and also consider the tax advantages of ISAs and SIPPs. Now, residential property is slightly separate, of course, to commercial property, but I am going to include a section on that at the end, just because I know many of you, if you're interested in investing in property, have probably thought about residential property buy to let in the past, and maybe we're just going to discuss a few of the headwinds that are facing that market. So, just to begin with, to put things in context, I think it's worth having a look at how commercial property has performed over the last 10 years or so. What you can see from this chart is that until very recently, commercial property was performing, holding its own really against equities and bonds. What we're looking at here is the average fund performance from each of these various sectors. So what you have, the red line is UK commercial property, open-ended funds. You have the red line, which is UK all companies, that's investing in the UK stock market, UK gilts, the funds investing in UK government bonds, and global equities is funds investing in the global stock market. So you can see UK commercial property holding its own against UK equities and also UK government bonds. But obviously, all of those assets have been put in the shade by global equities. Largely because that part of that particular sector has a very high weighting to the United States, and obviously the equity market in that region has done very well, driven in large part by some very large technology companies. So you can see that commercial property has had its downturns as well. So you can see around 2016, around the summer of 2016, around the EU referendum vote. We basically had a downturn there. There was a widespread turmoil in the market, lots of panic around kind of whether London was going to maintain its crown as a financial centre, what implications that might have for property, and general malaise about the UK property market in general. You can also see that there was a downturn around the pandemic. For obvious reasons. And then more recently, there's been another downturn in performance because of the current economic conditions, which we'll talk about in a bit more detail later on in the presentation. So, you can see here that commercial property has been, less volatile than the equity market. So a good example is during the pandemic, you can see that, in sort of February, March 2020, there's a very steep downturn in UK equities and global equities as well. There was a downturn in commercial property, but it was more gradual. Now, the flip side of that is that the equity market bounced back stronger and sharper. And so that's the other flip side of the volatility that you get with equities. But as you can see, commercial property acting as kind of providing returns, but less volatile than the equity market. I think there's an interesting comparison to be made with bonds there as well. It's been a very favorable period for bonds really up until the last 18 months. So they were performing pretty well. And then the last 18 months has been an absolute terrible time for bond investors. You can see that very sharp downturn at the end. And that's obviously because, loose monetary policy over the 10 years after the financial crisis drove up bond prices. Then we had a screeching U-turn in monetary policy as kind of interest rates had to rise to fight off inflation. So those are seen as a safe haven. I think if you're sitting on bonds and watching them fall by 30% or so over the course of a year, you probably don't think of them as much of a safe haven anymore, but that is generally how they're seen. And that does obviously have implications for bond investors. Has implications for other assets as well, including commercial property, and we'll also come on to talk about that in a moment. So it's worth kind of considering your kind of basic reasons for investing in commercial property. So obviously the reason for investing in any asset class is return. So you've got capital growth, which you get from commercial property. But the main thing that you're getting from commercial property, the main kind of critical component is income. And so yield is going to be a critical factor for any investors to potentially look at. Now, you can obviously kind of take the yield yourself, so draw it out, perhaps as part of sort of a pension retirement strategy if you're keeping your pension invested. The alternative is that you roll the income up, and so create a total return that way. As well as the yield, rental income growth is also an important component of your total income and your total return over a longer time period. As usual in the market, there's no such thing as a free lunch. So what you tend to get is a bit of a choice between jam today and jam tomorrow. So those properties which are offering potential for high rental growth will tend to have that priced in and perhaps showing lower starting yields than, for instance, properties where the rental growth is more limited or perhaps suspect. But income is a key reason why people might want to invest in commercial property. The other reason is diversification. So as we saw from the performance charts, the property behaves a bit differently to equities and bonds. So if you hold all of those things together at the portfolio level, it makes for a more smooth journey than holding any one of them in isolation. And so diversification is another reason why you might be attracted to property. Now, we often think of diversification in terms of risk, managing risk and managing volatility, and that's absolutely right. But also in this context, commercial property can be used to diversify income streams as well. So having that alongside your bonds and your equities adds to the sources of income that you're drawing on, and adds to the diversification and lowers the risk to your income. I think that's particularly salient if you think about, the UK equity market, where actually the dividends that are paid by, the FTSE 100 are dominated by, a few large dividend payers. So, obviously diversifying across stocks helps with that, diversifying into bonds helps with that, and diversifying into commercial property can help with that as well. So that's kind of how you might think about commercial property, looking at it from that point of view, probably as part of a portfolio. It's not really something you come to as your first investment. It's a complementary strategy alongside equities and bonds. So worth just having a think about also the types of commercial property that you've got out there. There are obviously a lot of sectors here. Some of them you may well be already familiar with. So retail space, obviously office space, industrial and logistics space. But there are lots of other specialist sectors as well. And these different areas can perform well and badly at different times. So during the pandemic, we saw logistics space performing pretty well because there's a greater demand for online deliveries and distribution units. And by the same token, at that time, retail struggled, and office space came under pressure as well because of the shift to home working. And you can get sectors which are more or less sensitive to economic changes as well. So if you think about a shop versus a healthcare property, in a recession, a shop is going to find that its revenues come under pressure because people are spending less, whereas in a healthcare setting, our healthcare needs don't go away just because of the economic climate. So again, there are various niches within commercial property, and all kind of can behave differently to each other at different times. So just moving on from that, really, and thinking about how the current economic situation is creating headwinds, obviously kind of for all of us, really, all of us, for the economy at large, and also for lots of asset classes, including commercial property. So, inflation is the big watchword at the moment, has been for some considerable time. Sorry, excuse me, it seems to have slipped off the slideshow. Right. Okay, hopefully you can see that again. In terms of kind of inflation, that is a problem for a lot of asset classes, including commercial property. That obviously takes money outside, off consumers because they're spending more money on their energy and their food costs. It also puts pressure on businesses. Now, those consumers spending more on energy and food costs are going to be facing, pressure on this discretionary spending. They're not spending with businesses, and so that puts pressure on businesses who themselves have higher energy costs and also higher inflationary costs in terms of labor as well, because obviously inflation means that people ask more from their wages. It also means that in the current environment, companies often have to pay up because we've got a very tight labor market. So not a good sign for anyone, inflation. Rising interest rates also problematic, again, putting pressure on consumers, meaning that money is being swallowed up by mortgage payments, less discretionary spending, more pressure again on businesses who themselves might be facing higher interest rates as well. So again, that means pressure building up in the system. Now, interestingly, I think rising interest rates also present a problem for commercial property as a bit of an investment destination as well. And it's not just commercial property, I think assets more generally, because we're now in a situation, we saw at the beginning that bond sell-off that we've seen. Obviously, that's not good for existing bond investors, but it does mean that you can now get pretty high yields, comparatively speaking, certainly comparatively to the last sort of 10 or 15 years on bonds. So your 2-year bonds at the moment currently yielding about 5%. Thank you very much. Similar for cash as well. So that really raises the bar for other assets, because those are seen as your safe havens. If those are yielding sort of 5% rather than 0 to 1%, we've been expecting for a very long time in times of loose monetary policy, then you get a knock-on effect on other asset prices. So I think that's been seen to some extent, that's priced in by falls that we've seen in the equity markets and also in commercial property, but just worth being aware of that dynamic, that if you do get interest rates creeping up, inflation being sticky, which is the kind of story at the moment, that may also be a headwind. And then finally, higher taxation. Again, similar situation, where it's taking money away from consumers and also from businesses as well. We've had a hike in corporation tax, 19 to 25% this year. We've also got frozen income tax thresholds and allowances being cut. So all of that puts pressure on consumers and businesses. So I don't probably need to tell anyone here the macroeconomic climate is not very pretty at the moment. I think the good news is that, across various markets, that has been priced in to a certain extent. So let's sort of think about how you might go about investing in commercial property. So the obvious route is to do it directly. You just go out there and you buy a shopping center or a theme park or an office block. But, most of us don't have the spare change to do that. So most of us will invest via funds. We pool our money together, investing via funds. And there are two main ways you do that. There are open-ended property funds and there are closed-ended property funds or real estate investment trusts. We're going to talk about both of those in more detail in a second, but also just worth saying that you can invest in property via multi-asset funds. So these are funds that invest in shares, in bonds and in cash and property, some of them as well. So it's a bit of a one-stop shop with the manager deciding what to invest in and what allocation to have to property, which might be of interest as well. And then finally, looking at residential property, we've got property shares, and we've also got buy to let as well, which we'll touch on towards the end of the presentation. So open-ended property funds, bit of an interesting one, this. So I think open-ended property funds used to be the kind of go-to for most people to gain property exposure. I think the main reason for that is because in theory it's possible to buy and sell at the net asset value of the underlying properties, and that's attractive. You don't have the price moving around during the day like you do with investment trusts, which are traded on the exchange. And that's probably why they were kind of in their heyday a very popular way of gaining exposure to property. In recent years, there have been some very big problems which have always really been there, but have really been brought to light by some big macroeconomic events that have occurred and have led to big withdrawals from the commercial property market. So the major issue is that there's a fundamental liquidity mismatch between the fund over here, which is saying to investors, you can buy or sell our fund every day, and the commercial properties which they're investing in over here, which can't be bought or sold. every day. So if you get lots of withdrawals in a day or a week for a fund, then you're in a bit of a sticky spot, because you can't sell, an office block like the Walkie Talkie or a shopping centre like the Bullring in a matter of days, in the way that you might be able to if you hold Vodafone shares in an equity fund. So that means that you're in a sticky spot. And what's happened at times of stress, when there have been big withdrawals recently, is that those funds have suspended dealing. So people haven't been able to get their money out, and sometimes for very long periods of time, which I don't have to tell you is a not far from ideal situation. So that's led to actually quite a lot of money flowing out of these funds, and some of them closing down or merging. And so it's a much more chastened sector than it used to be. It's worth noting that the FCA has also looked at this sector, has got some proposals on the table which are yet to be confirmed, that it will bring in mandatory notice periods for property funds. So you'll have to wait possibly 90, possibly 180 days to get your money back. So again, that might not be positive. I think most investors will probably look quite dimly at having to wait that long. I think even if you are willing to wait that long, there's another problem which is created by this liquidity mismatch at the moment, which is these open-ended property funds have quite high cash holdings within them. So in order to forestall the chance of having to close their funds to dealing, so to stop dealing, open-ended property funds tend to hold sort of at the moment somewhere around 15%, maybe more, in cash. So that if they do get lots of withdrawals, they can just use cash rather than selling properties, which is sensible given the structure. But that's, again, not particularly great for investors. That's quite a lot of your money that you've invested in a fund not really doing what you'd expect it to. I think most people would expect most or all of their money to be invested in commercial property. So just being aware of that as well. So the alternative that we're going to discuss as well is, of course, closed-ended investment vehicles or investment trusts. Now, these are tradable on the market. So throughout the day, you can buy or sell, not always at the net asset value. Normally, it will be at a discount or at a premium to that net asset value, because the market tends to bounce around a bit more because it's driven by market forces and is more sentiment driven. So that creates higher volatility. So you can see that here from this chart. What we've got is the red line is showing you the average open-ended commercial property fund. The blue blue line is showing you the average closed-ended investment trust. And you can see that they end up roughly at the same place over 10 years, but the blue line, the investment trust, has greater volatility. So again, that's because of the intraday dealing. You've got a discount and a premium situation, but importantly, you therefore don't get the trading suspensions. You can still sell these assets because they're a fixed pool of capital. What you've got is shares trading on a secondary exchange. So what you'll tend to find is that in times of market turmoil in the commercial property market, when open-ended funds are gating their funds, and you've got dealing suspensions, the commercial property investment trusts will have discounts tend to widen. So you can still sell them, but there is a price for that liquidity, because you might not get a particularly nice price, but you still have liquidity, so you can still access your capital. So that's kind of, you pay your money, you take your choice, but I think on balance most investors would probably prefer that. And you also don't get this situation where you've got managers hanging on to large amounts of cash because they have to manage withdrawals and money flowing into their funds. So another problem that's kind of diverted by the investment trusts as structure. You also tend, I'd say, to get a wider range of sectors available within investment trusts. More specialist areas, open-ended funds, you'll tend to find are kind of broader, by and large, across kind of the commercial property market. You do get that sort of thing in investment trusts as well, but you can also get more specialist investment trusts investing in kind of, more niche areas if you do want it. So here's just a few examples of the kind of areas that you might be able to get in with investment trusts. So just worth bearing that in mind as well. So I said I'm going to talk about buy to let, and that's because I think the market is very much under the pump at the moment. It's been a fantastic run the buy-to-let had, kind of all the kind of years of low interest rates, helping people to get, kind of buy a second property and finance it with the rent. Well, the worms really turned on that, I think, with mortgage interest payments. I suspect a lot of landlords are going to find that it's much more difficult now to actually turn a profit with interest rates where they are. We've also had some tax changes which make buy-to-let less attractive. So interest rate relief is now limited to 20%. Rather than being paid at your marginal rate of income tax. You've also got that 3% extra stamp duty on second home purchases, and you pay capital gains tax 8% more than you'd pay on shares, and the capital gains tax allowance is being cut as well. And another thing to bear in mind if you are considering going down this route is the ongoing costs. So, maintenance, things like insurance, letting fees and void periods, which is very easy to leave off a profitability analysis, but which really do eat into your profits. So just, kind of there are, I think it's a difficult time for buy to let. And, if you're thinking about going to this market, then to make a profit, you probably need to get the right property. It's not the kind of free and easy marketplace that it was for a very long time. Also, you can invest in property indirectly, in residential property, through various companies that are listed on the stock market. So here's, a fairly random selection, kind of house builders, estate agents, etc. So this gives you indirect exposure to property. You're not holding property itself, you're holding companies that have something to do with property and are linked to that market. They're obviously shares, so you do get the kind of volatility of equities with these companies, but another way that you can get exposure to property, residential property, through the market. And just to round us off, I thought it worth sort of highlighting how the tax situation is changing for investors. We're all kind of familiar with the idea that we're paying higher taxes. Unfortunately, the income tax thresholds have been frozen. The top rate thresholds actually been brought down. And for investors, we've also got these changes coming through to the dividend allowance and the capital gains tax allowance. The dividend allowance is being cut from £2,000 last year. It's going down to £500 next year. Capital gains tax allowance going from £12,300 last year to £3,000 next year. So that's going to mean a lot more people paying an awful lot more tax, especially investors, I'm afraid. Your way to kind of mitigate that is to wrap as much as you can within pensions and ISAs. So this is kind of a worked example how your £100 dividend would be protected by an ISA, whereas if you hold it outside an ISA, unfortunately, those dividend taxes, once you get above the dividend allowance, is going to start eating up your dividend, and meaning you get less income ultimately in your pocket. So I think that's it from me so far. So thank you very much for listening to that. You can see a disclaimer there for you to read. I think we've got one more as well, so I'll just bring that up. There we go. So as I say, thank you very much.